In investing, when it comes to generating exceptional investment returns, the most important factor to consider is a company's quality, because finding and owning ultra high quality stocks is what is going to produce the majority of your long-term returns. But what makes quality investing so difficult is that quality is very hard to measure. Some would even argue that it is almost impossible to measure a business's quality with a single or a few metrics, because quality includes many more nuanced, subjective and unquantifiable factors. But that doesn't mean that you shouldn't try to measure business quality. And in this video, I will outline 2 investing metrics that every quality-focused investor should look at before making a new investment. So without further ado, let's get started. There's a very famous quote by arguably the most successful business person in modern history, Jeff Bezos. He once said, "The number one thing that has made us successful by far is obsessive compulsive focus on the customer as opposed to obsession over the competitor." And this quote in a way brings us to the topic of today's video. I think an often underutilized and overlooked factor by investors all around the world is to look at and measure how customers of a company experience the products or services provided by that company. Personally, I like to invest in companies whose customers absolutely love the product or service of that business, because this gives me an additional qualitative margin of safety, besides the quantitative margin of safety of paying a low price relative to the intrinsic value of that stock. And Jeff Bezos' Amazon is arguably the prime example of an obsessive focus on customers' experience, focusing on what customers want or need, as opposed to maxing out Amazon's short-term profits. This is what has driven many of Amazon's most successful and prominent business moves, and what has led to the exceptional long-term performance of Amazon's stock. And there are 2 ways to actually measure to what extent a company is able to delight its customers. And please stay tuned, because the second metric that I will talk about in just a minute is arguably even more powerful than the first one. But let's start with the first metric. In a way, the customer experience is reflected in the brand of a company and the brand awareness among its consumers in general and its target audience in particular. But what is actually a brand? According to Bruce Greenwald, brands are identifiable product images that exist in the minds of consumers and affect their behavior in ways beneficial to the company that owns the brand. So brand strength and awareness are important, because consumers generally trust recognized brands to produce better and safer products than unrecognized brands, which in turn leads to higher revenues and greater customer loyalty. Now, to measure the reach of a brand, one of the most common metrics in market research is to look at unaided and aided brand awareness. Aided awareness is simply measured by conducting a survey, showing people a list of brands and asking the survey participants which brands they know, which ones they are aware of. Aided brand awareness is then expressed as a percentage, the percentage of people who are aware of a product, service or brand. On the other hand, unaided awareness reflects the percentage of respondents who are aware of your product, service or brand without being assisted. So for example, a question that may be used in market research may be, which brands first come to your mind when you think about clothing? This is sometimes also referred to as top of mind brand awareness, and it is a special form of brand awareness. And companies, of course, measure this metric. A company that I own, Etsy, has been particularly vocal about winning consumers' mindshare. To provide just one example, let me quote a passage from the most recent Q1 conference call. Here's what they said. "The top 3 reasons men give for not shopping on Etsy are very similar to the reasons women give, although all relate to awareness. Etsy hasn't come to mind. I haven't had a need for the types of items they sell, and I don't know what Etsy offers. We estimate 35% of our new US buyers in 2021 identify as men. We're just getting started understanding these buyers and developing products and marketing strategies to help them learn the when and the why of Etsy." so we can come to mind more often. Now, the problem with this metric, brand awareness, may be that simply being aware of a brand does not necessarily mean that the people are actually delighted by the experience provided by that brand, their service or their product. It just measures awareness. And this brings us to the second metric that I want to talk about, and that should be the core focus of this video. Another quantitative metric to measure customer satisfaction is the so-called Net Promoter Score, or in short, NPS. And it is the percentage of customers rating their likelihood to recommend a company, a product or a service to a friend or a colleague. The metric was first developed in 2002 by Bain & Company, and it is now used by literally millions of companies around the world to measure and track how their brand and products and services are perceived by their customers. Now, the Net Promoter Score is based on one simple question. How likely is it that you would recommend organization X, product Y or service C to a friend or a colleague? Survey participants are then asked to give a rating between 0, not at all likely, and 10, extremely likely, and respondents then fall into one of 3 categories depending on their response. Promoters are those who are responding with a 9 or a 10, and they are typically loyal and enthusiastic customers. Passives, those who are responding with a 7 or 8, are satisfied with the product or service, but not happy enough to be considered promoters. And finally, we have detractors, those who are responding with a score between 0 and 6, and they are unhappy customers who are unlikely to buy from you again and may even discourage others from buying from that company. To calculate the final Net Promoter Score, one then subtracts the percentage of detractors from the percentage of promoters. So if, for instance, 20% of respondents are detractors, unhappy with the company's service or product, 20% are passives and 60% are promoters, well, then the firm's Net Promoter Score would be 40. 60 minus 20. And as I said, as an investor, you want to identify companies that consistently delight their customers, because then in turn, consumers will love the company. A high Net Promoter Score will lead to low customer acquisition costs and a high lifetime customer value. So what's a good Net Promoter Score? Well, how high the measured customer satisfaction should be depends on a lot of factors, but most importantly, the sector the business is operating in. Generally speaking, you cannot compare the NPS, so Net Promoter Score, of a logistics company, which tend to have very low customer satisfaction rates, to an education-focused company, for example, which tend to have high or very high satisfaction rates. Arguably, any score over 0 can be considered good, as there are more promoters than detractors. But I'd like to see a higher satisfaction rates in the businesses I own. Again, they should be delighting their customers. Bain & Company, they suggest the following classification. Above 0 is good, above 20 is favorable, a score above 50 is excellent, and finally a score above 80, well, that can be considered world class. To provide one real-life example here, I'm not sure if you know Mr. Specs. Mr. Specs is an online-driven, omni-channel optical brand that provides eyewear products in Germany and some other countries. Now, the eyewear shopping experience is not always a pleasurable experience, and anyone who wears glasses knows the pain points of buying a pair of glasses all too well. Nonetheless, Mr. Specs regularly achieves an NPS above 70, which in this context I would consider very good. Now, if you want to learn more about another very well-known investing metric, the price to earnings ratio, or in short PE ratio, I recommend you watch the following video next, in which I explain why high PE stocks may actually be very cheap. Take care.